Look, I do. I think the challenge you have with passive strategies is they're dumb, and I don't mean unintelligent. I mean they're rule-based, so they don't get to think. So when the markets are going up, they buy, and when the markets start going down, they sell.
All right. Well, I give you that. I mean, maybe that's why we had a stronger sell-off than I think many expected yesterday and the days before that.
Yep.
But things are pretty good. I mean, once we get over this little tantrum we're having over the Fed raising rates, won't we get back to normal?
Well, I think we are going to go back to normal, and I think the problem is normal is a long way down from here. We've been overvalued for a very long time. We're at double normal valuations. That means about a 50% drop. We've got massive leverage in the system. We've got the highest leverage we've ever had in the system when you take, margin debt, when you look at the levered ETFs, when you look at the speculative positions in futures. The average investor is 103% invested long. That's not a good place to be when things turn down. So I think there's a lot of downside to come, and I think people should get prepared for it.
What's going to cause the scenario to not reverse itself? I mean, there's still, you're going to have earnings season. I get that we've had, some pre-announcements that have been pretty negative.
Yeah.
But I think people are pretty decent with the fact that rates are going up for the right reason. At least that's the argument.
Well, I think I have a couple problems. One is 76% of earnings forecasts have been negative so far by people who have announced earnings. That's not very good. I think we've seen the earnings peak for this cycle with the tax reform, basically just a windfall for companies for one quarter back in Q2. So I think, we've kind of had this coming for a while. The economy had one shot of adrenaline, but we're still, slowing again. Rising rates will restrict liquidity. Lower liquidity always leads to lower growth, which leads to lower stock prices. And the last thing is trade wars. There has never been a time when global trade declined that global profits didn't decline and global stocks didn't decline. If you look around the world, global stocks have been declining all year, and now it's time for the U.S. to catch down.
All right, so Mark, it's Dominic here. One of the big causes for concern right now is this upcoming earnings season. So as we take a look at what you're focused on, is there anything out there that would give you either a lot more optimism or a bit more pessimism about how corporate earnings are structured and how they move going forward?
Yeah, look, I think the biggest challenge with earnings is I call it the mind the gap syndrome, the difference between gap earnings and reported earnings, or as I call it, earnings before bad stuff, pro forma earnings. People say, oh, well, we had non-recurring things that seem to recur every quarter, and they don't count it. Well, it counts. Cash is what counts, and so we need to keep an eye on cash flowed businesses, and that's getting tight. Look, we've had a long economic expansion, second longest in history at 110 months. That's going to come to an end at some point, maybe next year. So it's just a normal, natural cycle and a progression. And we've got very highly overvalued stocks. We've seen a lot of those go down abruptly yesterday. And the real problem comes when people are forced to sell because of margin debt or leverage. And that's when things could get really ugly.